Most financial gurus insist you need $1 million to feel wealthy, or a six-figure salary to build serious net worth. But the math, and more importantly, human psychology, points to a much smaller, powerful milestone: $20,000. When you lack a cash buffer, your brain operates in a state psychologists call survival mode. Every single choice you make is filtered through a lens of fear, because one unexpected bill can derail your entire month. You agonize over a $3 coffee, standing in the cereal aisle, calculating generic versus brand name. These micro-stressors consume massive amounts of your mental bandwidth. This scarcity directly compromises your career. If you cannot afford to miss a single paycheck, you are forced to stay in toxic work environments. You take the first offer that comes your way, and you avoid negotiating for a raise because the risk of being fired is too high. It is like trying to plan a vacation while your house is actively on fire. When your financial resources are completely tied up in short-term survival, your brain literally lacks the capacity to recognize or plan for long-term growth. Based on Vanguard research, accumulating just $2,000 in emergency savings spikes baseline well-being by 21%. Expand that safety net to $20,000, and you see another jump, a cumulative 34% boost in financial well-being. With that buffer in place, the constant anxiety quiets down. You stop reacting to immediate financial crises and begin proactively planning for the future. Reaching this threshold provides enough security to stop reactive thinking. It creates the mental space needed to focus on strategy instead of survival. Let's map out exactly how this acceleration works in practice. Suppose you are saving $1,000 a month and earning an 8% annual return on your investments. This timeline graph tracks those contributions over time. Getting to your first $20,000 requires 19 months of steady, manual effort and extreme discipline. But accumulating your second $20,000 takes 17 months. You are doing the exact same amount of work, but your initial capital is now generating its own returns alongside your monthly deposits. Once your portfolio hits $400,000, the curve goes completely exponential. You generate your next $20,000 in just 5 months without increasing your monthly savings rate at all. Early on, an 8% return on a couple $1,000s yields less than $200. Nice, but easy to ignore. An 8% return on $20,000 creates $1,600 of pure profit flowing into your account over a year without you lifting a finger. $20,000 is the exact threshold where the mathematics of compound interest finally overpower the financial gravity keeping you broke. Executing that math requires intense focus. To get off zero, you have to track where every dollar goes, say no to things you want, and consistently save month after month. By surviving that grueling 19-month period, you prove to yourself that you possess the willpower to delay gratification. The process changes your relationship with money. You stop being someone who simply reacts to their bank balance and start being the person who decides exactly where every dollar goes. When your car needs repairs or your laptop dies, it stops being a disaster that ruins your month. It becomes a minor inconvenience, or perhaps a prompt to upgrade your equipment. You start noticing opportunities that were always there. When a friend needs an investor for a business, or suddenly a distressed rental property hits the market, you actually run the numbers instead of ignoring it out of fear. You also gain what is called walking away money. This changes your position at work because you know you could survive for months without that specific paycheck while you look for something better. Because you are no longer terrified of missing a single paycheck, you negotiate assertively. You push back on unreasonable requests and take on riskier, high-profile projects. That confidence results in better assignments, brings you far greater recognition, and ultimately a much higher income. You also stop stressing whether to buy the name brand cereal or make your coffee at home. You realize the difference is maybe a few $100s a year. Instead, all of that freed up mental energy gets redirected into major structural decisions. You optimize your housing costs, plan your career trajectory, and fine-tune your investment strategy. But there is a massive trap here. Many people hit this milestone and immediately blow it on a depreciating asset, like a brand new car, as a reward for their discipline. Let's look at a comparative chart. Spending $30,000 on a new car destroys wealth as the asset rapidly decays. But if you take that same $30,000 and invest it, It yields over $200,000 across a 20-year span. Accumulating $20,000 provides the initial momentum and clarity needed to pursue long-term independence.